想在当前变幻莫测的市场里分清什么是深思熟虑的策略，什么又是纯粹的投机，这并不容易，尤其是在一些关键事件发生前夕。听见资本本期视频为您带来的是 LP Macro 阿尔派宏观4月2日闭门会，主题是策略与投机分离。如果有人告诉你他们对接下来几周甚至这个月会发生什么了如指掌，那你可能要掂量一下他们的可信度了。市场屏息以待，但别指望一两天就能尘埃落定，真正的考验在后面几周几个月，那将决定最终的交易环境和你的资金走向。即将到来的事件可能不会解决所有问题，但它会提供足够的政策线索，让投资者开始分析具体数字，这可能会点燃个股和板块的行情，而不是之前那种剧烈波动的宏观大趋势。核心建议是，除非你对政策有超乎寻常的洞察力，否则不要在没有高度把握的情况下进行大的压注。美国经济数据现在有点分裂，硬数据和软数据各说各话。虽然增长和通胀在放缓，但远未到崩盘的地步。企业利润也许不算惊艳，但也还没看到下滑的迹象，甚至可能因为美元走弱和提前进出口而短期内超出预期。这可能会让看空的人大跌眼镜，甚至在财报季阻止市场回调。有人说美国市场的优势不在资金正从美国科技股流向欧洲或亚洲，但这种看法可能为时过早。所谓的美国例外论并没有消失，美国大型科技股的强大并非基于暂时的政治因素，而是源于他们更高质量、增长更快、更盈利的全球性商业模式。认为他们的时代已经结束可能是危险的，即将到来的财报季或许会证明这一点。最近这些科技股的抛售可能已经过头了，那么该如何应对？一种反击策略被提了出来，通过平衡防御性板块，比如房地产、公用事业和医疗保健，来对冲风险，同时在科技和通信服务领域寻找机会性上涨空间。这种方法旨在结合收益来源和盈利增长，避免掉入价值陷阱，同时又保留足够的风险敞口，以便在增长型公司公布强劲业绩时分一杯羹。贸易紧张局势下，投资者似乎有些茫然，不加区分的抛售，但仔细分析，金融、房地产、公用事业等板块相对更安全。不过要小心，像必需消费品这样看似防御的板块，其实对关税的敏感度可能比你想象的要高，而且估值偏贵。另外，特别提醒，汽车保险公司可能会因为关税导致车辆及零部件价格上涨而面临更大的赔付压力。相反，房地产和公用事业板块则因为受益于利率下降预期以及自身的增长逻辑，如电力需求驱动的资本开支而受到青睐。总而言之，这段分析的核心观点是，在高度不确定性中保持谨慎，但不要完全离场。通过平衡防御与进攻，聚焦高质量增长，并对美国市场的韧性保持信心，可能是当下更明智的选择。准备好迎接可能出现的意外惊喜，尤其是来自企业盈利方面的。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Well, if you ever needed to separate strategy from speculation, this is it on Liberation Day Eve. Because if anyone is telling you that they know with much certainty what's going to happen this month, let alone this week, that probably says something about their credibility. So tomorrow we'll wait with bated breath and traders will push around prices, but obviously the days, weeks, even months after will be extremely consequential in what the ultimate trade environment is going to look like and mean from a dollar and cents perspective. We do not see tomorrow as a quote unquote clearing event, but it should be a tradable event, meaning that we're not going to get any sort of finality on anything, but there should be just enough policy contours where investors can start to actually parse some numbers, and it probably juices up some single stock or even sector activity as opposed to more of the broad macro trends that have been whipsawing around. Now, our main points have been, unless you really have a clairvoyant edge on the policy front, which really no one does, you probably don't want to be taking big swings at anything other than high conviction views. Now, in the US, there's a major divide between hard data and soft data, some of it due to political bias. But really, the ultimate trend is that growth and inflation are weakening, just not dropping like a rock. So likewise, corporate profits, they might not be gangbusters, but there's not enough evidence yet that they'll roll over. In fact, some of the fallout from trade fears, think of the weaker dollar, front-running imports and exports, that should actually boost Q1 results. And then finally, U.S. exceptionalism, in our view, it's not dead. The pivot away from U.S. tech to European cyclicals or Asia tech, we think it's likely to be temporary, and reporting season could be the proof point. So when you take all this into account, we're start that last point over. So taking that into account, we're promoting this counterattack strategy where we neutralize risks with a balance of defensive U.S. exposure in sectors such as real estate, utilities, pockets of healthcare, with opportunistic upside, and then newfound value of less cyclical tech and communication services. We think this is a nice way of pairing sources of yield with profitable growth to avoid value traps while also keeping enough skin in the game for when fast growers report strong results. Let's dig into the slides. So far, the hard data is pointing to reasonable growth even as soft and survey data fall off a cliff, which isn't terminal for equity prices or fundamentals. But as the baseball player Yogi Berra would say, it is getting late early. Because at some point, sentiment or what you say you're going to do, it starts to bleed into what you actually do. Now, the most consequential exhibit of this effect is what we show here on the right in our global boosters and bunkers model, which incorporates a handful of statistically significant hard and soft measures and has a very strong track record of leading U.S. corporate profits. Now, the soft data is pushing it down. Interestingly, the last false positive was during the 2018-2019 trade war or Fed funds policy mistake. Again, the takeaway is nothing is broken yet, but you tempt fate long enough as that uncertainty remains elevated. Now, in terms of the top-down growth setup, it's still looking pretty good, which is really what matters over the intermediate term for equities. We show here that the growth rate for 2025, it's come in a bit. That's really only because 2024's growth exceeded expectations. Meanwhile, growth in the outer 2026 period ratchets higher. That's completely normal, by the way, in healthy and advancing markets. And then what's missed by some of the bears that are calling for profits to imminently roll over is that the dollar's weakening, and that's an easy boost to the top line. That's probably good for a 1% tailwind as opposed to what most companies had been building in, which was a 1% to 2% headwind. And then secondly, the front running of imports, just overall trade, that also should be maybe a headwind for the GDP calculations, but a tailwind for revenues and profits. So if you're calling for an earnings recession, it really should be later, not sooner. And this could surprise investors and arrest the correction come reporting season. Two additional points we'll make. First being, analysts have been adjusting their estimates lower, but that's normal. And they're doing it with very low uncertainty. And then secondly, the growth differential for U.S. leadership, it is still significant and very difficult to ignore. Now, on the bottom left, you see that the skew of earnings revisions for this year, it has been negative over the past few months, meaning there is more downgrades than upgrades, but it happens often. Right? This typically does occur when you enter a new year. Now, what provides a bit more confidence is that the variance across consensus estimates, that's pretty tight. You see this on the top left. It means that the analyst community seems convinced in their outlook. That's usually not the case during recessions or periods of turbulence. So that inspires a bit more confidence. Now, on the right side, we're showing sales and profit projections across the market in certain segments. A couple of takeaways. The first being that growth estimates are still very solid and spread across sales and margins. That's healthy. And then secondly, just take a look at U.S. megatech or even just tech. You compare that to other U.S. segments or international, for example. I mean, the growth differential, it is hard to ignore. It's going to be especially hard to ignore if tariffs do induce a global slowdown. This is one of the reasons, in our view, it's just perilous to pivot away from U.S. exceptionalism on what otherwise could be temporary geopolitical frictions. Now, it's hardly a surprise, but investor sentiment's very much washed out, and positioning levels are starting to illustrate some of that with flows out of U.S. and tech into defensives and other regions such as Europe. You can see this through ETF flows, as a matter of fact. This is all to say, sentiment tends to be a contrarian indicator for future returns outside of true fundamental inflection points. So, should investors be using this as a trading role? No. But should it be considered when monitoring for bottoms or extremes? Absolutely. Now, on the right side, I think it's interesting to call out that the straddle price for this week was more expensive than any other straddle at least since last summer, meaning investors are expecting more market price movement given tariff day and all of this week's economic data than any other recent point. Really important. So clearly, the market's not sleepwalking through any of this, and that's healthy, a good, healthy reflection of the risk price mechanism. And what we've learned on the tariff side is that investors, they either don't know or they just don't care about the effects on different market segments because they're really indiscriminately punishing all of them just about equally. We highlight all of the days during the first Trump trade war and the current episode where major trade developments or provocations took place. There's basically no difference in the performance across growth or value or large or small cap. They all tend to go down. Now, on a sector basis, though, you can get a bit more nuanced. And I think this is potentially where more investors start to go to work after tomorrow. There really aren't many areas immune to trade risks, right? You have to also consider the secondary effects on growth or inflation. But from a sector standpoint, financials, real estate, utilities, yeah, they're going to be better insulated to varying degrees. Then the picture becomes a bit more muddled. But I think investors could do well to evaluate sectors, industries, even companies as to country or region specific exposures as deals start to be made. And we're going to provide a lot more research on that, including baskets. The other big headwind for U.S. equities, of course, has been the deterioration of what we call megatech. Here, we're of the belief that the sell-off is overdone. We think once these companies post blowout results that sort of lap resources or cyclical segments by 3-4x, investors just won't be able to ignore it at some point. Now, our main takeaway is that U.S. tech's exceptionalism, let me start the slide 7 again. The other big headwind for U.S. equities, of course, has been the deterioration of what we call megatech. And here, we're of the belief that the sell-off is certainly overdone. And we believe once many of these companies post blowout results that lap resource or cyclical segments by 3 or 4 times in terms of growth, we don't think investors are going to be able to ignore it. Our main point is that U.S. tech's exceptionalism, it was not based on the political backdrop or any sort of temporary machinations. It's really based on just higher quality, faster growing, and more profitable business models than you could find anywhere else. I mean, if you think about it, many of these companies, they're deriving 30-40% of their revenues from abroad. That's not U.S. exceptionalism. That's not a U.S. pure play by any means. Now, you could argue that these companies are cheap, actually, when you account for their fast growth and the durability of that growth. Using NVIDIA, for example, Jensen Huang has said that they have 3.6 million orders for Blackwell chips from the top 4 hyperscalers alone. That's more than double the Hopper chips that shipped at the peak. Right now, could other regions punish these companies, slap regulations or tariffs, et cetera, on them? Absolutely. But that's just anti-competitiveness as opposed to protectionist. So we don't think that the competitive advantages that these hyperscalers and that these U.S. tech companies have, we don't think they're going away anytime soon. Now, one of the big trends we're seeing is that U.S. CapEx is being punished, even as CapEx intensity in other regions, such as Europe and China, it's actually outperforming. You see that on the left side. Now, there's really not many reasons for that spread to last very long. The less you think U.S. investment is just impaired for some reason, and generally it's not on a regional basis, that spread should compress at some point. Now, on the right side, you see the U.S. sectors that have the greatest CapEx spend outs along with the growth rates of that CapEx. And basically, outside of the resource intensive sectors like energy and materials, you're really seeing most of the concentration in the tech adjacent, so discretionary, communication services, and of course, technology. The other big trend we're seeing is that yield is working in a big way across size, style, sectors, and even regions. And this trend, I think this actually has some durability because it makes complete sense, right? You want to get paid to wait as a shareholder while uncertainty is high. So think of higher dividend yield, free cash flow yield, also dividend growth. They're working. Now, a balance of higher yield with growth, that's actually a very attractive method at this point for getting some of that paid to wait exposure while also maintaining some upside if or when the macro backdrop starts to stabilize. So let's get into some charts to call out what is working, right? On the left, we're showing insurance. Two different measures of insurance, though, financial insurance and healthcare insurance. Now, just by its very nature, the industry or the business of insurance tends to be pretty defensive, right? You're collecting premiums, you're paying out on some actuarial assumptions, and usually aren't too volatile. So you're seeing right now both health insurers and financial insurers, and that would include profit. Let me start the slide 10 again. I'm sorry. Now let's get into some charts to call out what is working. Now, insurance, by its nature, happens to be a pretty defensive business model. If you think about it, you're collecting premiums, you're paying out on some actuarial assumptions that usually they're not that volatile. So you're seeing both health insurers and financial insurers, which would include property and casualty, but also the autos, they're outperforming. Now, we'd actually stick with the health insurers. They have some more durable fundamental tailwinds, but we'd be fading insurers with more auto exposure. Think about it. I mean, the latter, auto insurance exposure, they're going to face steeper payout pressures if or when vehicles and then vehicle prices jump as a result of tariffs. Now, these prices are, let me start this slide again. I'm sorry, slide 10. It's the second outtake. So let's get into some charts to call out what is working. Now, insurance, just by its very nature, it's a pretty defensive business model. You're basically collecting premiums and you're paying out on some actuarial assumptions, and those usually aren't too volatile. And you're seeing both health insurers and financial insurers, which includes property and casualty, but also the autos, they're outperforming. Now, we would stick with health insurers. I think they have some more durable fundamental tailwinds, but we would fade insurers with more auto exposure because the latter could actually face steeper payout pressures if or when vehicle prices, vehicle part prices jump as a result of tariffs. Those prices, as we're showing on the bottom left, they're inversely correlated with the profits for auto insurers over the short run. Now, on the other side, we're still cautious on staples, right? And staples have been an outperformer, and we've lagged there, but we're just not ready to buy it. Now, obviously, staples are a quintessential defensive, but they're very much more exposed to tariffs than many realize, and they're just plain expensive without offering much in the way of upside potential. We would fade staples still at this point. Now, a couple of sectors we have been leaning into are real estate and utilities. First, both sectors are prime beneficiaries of lower yields as it, of course, boosts valuations, but also lowers their funding costs. Now, the relative performance of real estate and yields, we show this on the top left. Look how tightly correlated it is on an inverse basis. Secondly, there are some cyclical tailwinds there. Now, the real estate sector, it continues to recover outside of the typical business cycle, right? There's a different schedule there. Many pockets, so think of industrials, for example, they've been troughing for a couple of years now. They're ready to actually turn higher. Now, in the utility space, I mean, the thirst for CapEx to satiate electricity demand is just absolutely incredible. And it's way bigger than just a data center story. And then you add in the defensive characteristics. And yeah, there's enough upside within utilities to go along with that downside protection. So we think both sectors are good counterattack candidates. So that's it on the eve of Liberation Day. Our main points are to neutralize risks outside of high conviction views. And that means that counterattack strategy, balancing well-positioned defense with quality and profitable growers. We do expect corporate profits to surprise to the upside in Q1, and we believe they're still on a solid path. Now, that can change if uncertainty remains elevated, but nothing is terminal or set in stone yet. And then finally, in our view, U.S. exceptionalism, it's not dead. Megatech's dominance, it wasn't cyclical or based on transitory characteristics. These are global companies that simply do business better. And reporting season could be a wake-up call to catalyze a slight rotation back. So thanks for joining us at Alpine Macro. Please reach out if we can help your process in any way, and we'll see you on the tape.